What's good, all my trader and investor homies? It's your boy Kevin. This is Touchdown Trades, the home of the #1 stock market trading and investing channel on all of YouTube. In today's video, we're going to be breaking down 3 things that I'm doing in my trading and my investing to prevent me from suffering massive losses in the stock market. Over the last couple of weeks, we have seen some crazy price action in some of the sectors that I love most. Renewable energy, EV, solar, 2 sectors that I am in love with, but they've got beaten down, and that's okay. But I've seen a lot of new traders, a lot of new investors getting scared, taking big losses because they're not doing it right. They are chasing hype. They are chasing FOMO, and you're gonna get hurt if you do that. So we're gonna be breaking down a few things that I do in my personal investing that helps me to prevent just that. Prevent getting hurt. The name of the game is to make money, not get crushed. And if you're doing the wrong stuff, if you're doing these things that we're going to be breaking down in today's video, you are liable to lose money and not make money, and nobody wants that. If you want free money is the best money, then check out the link in the description for Webull, my broker. They're giving you free money, 2 free stocks valued up to $1,850 if you sign up with the link in the description. Also, I just created a Patreon. I haven't had a Patreon, I just created one. If you sign up, you get access to come trade with me, get my buy and sell alerts in the private Discord chat. There's about 500 people in there right now, and there's gonna be limited seats, so check out Patreon, link in the description. All right, let's break down what not to do and what to do in this more volatile market. Let's get it. All right. The stock market, you would have thought, had crashed 50%. By what has been talked about on social media, YouTube, the reactions of retail investors and traders around the world. It's cry face emoji, everybody's sad. The market's not even down that much. Look at this S&P 500 chart. The market took a little nap for about a week, and everybody's running home to their mom crying that they lost their college tuition. Look at the SPY. It's barely down anything. Sure, my portfolio is down about 15 to 18%, fluctuating over the last couple of weeks, but that's because I'm heavily invested in growth stocks. And I am a growth stock investor. I'm sure a bunch of you guys are as well. So we're gonna take bigger hits when the market has a pullback. We are in more volatile stocks. That's just the way it is. But a lot of people are doing stuff the wrong way. And we're going to be talking about that in today's video. The market is barely down. It's still trading at all-time highs. You shouldn't be super leveraged to the point where if there's any type of pullback in the market that you get crushed. I think the start of this was the CCIV hype. You have stuff going on YouTube that is just disgusting. People hyping up stocks after they made 300-400% moves. And sure, I've talked about Lucid Motors. I talk about growth stocks and penny stocks all the time. But I always preach, do not chase the FOMO. If you chase the FOMO, more often than not, you're gonna get hurt. And I'm not saying Lucid Motors is a bad company. I really like its long-term outlook. But what do you expect to happen when a stock goes from $10 when a merger is not even confirmed? You have no idea what the valuation of a company is going to be, and then it goes all the way up to $66 a share. Do you think you're going to work out if you buy it at 50 and try to bag hold it all the way up to $100? There's eventually going to be a time where you're going to be down money. So if you get super leveraged, buy on margin at $50 a share. I'm sorry, that's just not a good call in my opinion. You have to buy pullbacks. You got to buy the dip and sell the rip. Second of all, if you're not doing your own research and you're going off YouTubers who are getting their information, doing their due diligence and their research off of their phone and showing you articles off of Robinhood's newsfeed, then you're just buying FOMO, you're just buying hype, and you get crushed. That's the way it works. You have to do your own research. You have to do your own due diligence. You have to understand how to value a company. Price doesn't matter. The only thing that matters is market cap. People think a $30 stock is cheaper than a $5 stock. And that's not always the case. You have to understand how companies are priced. Market caps define a company's value, not the per share price. Tons of new traders don't even understand that. They think just because a stock is $30 and another stock is $10, the $10 stock is a better deal. They're in the same sector. Maybe you think the $10 stock's cheaper, so you buy in, but the $10 stock can have a bigger market cap than the $30 stock because there's more outstanding shares or the float is bigger. So that's something you need to understand as well. But to get back to my point, please consider not buying these huge 500% run-ups. Wait for pullbacks, buy in front of support, and then sell the rip. So rule number one not to break is do not buy the rip and sell the dip. That's the reverse that we want to do. We want to buy the dip and sell the rip to the moon, baby. All right, so number two, stay up to date with what's going on in politics, right? So a couple of weeks ago, I did a video how I thought that the stimulus bill was going to be approved. Biden had came off the $15 per hour minimum wage hike. He was talking about backing off of that, removing it from the stimulus bill. I thought the bill was going to go through. The checks were going to get passed. That would create an injection of capital into the market. And I thought the S&P 500, the SPY, was going to break over $400 and we were going to get a pop. Well, Biden got a lot of pushback over not including the $15 per hour minimum wage in the stimulus from his own party. So he put it back in there. He said he wants it back in there, and now it's back in there. Let me break something down for you. The stimulus bill will never, ever, ever get passed with that $15 minimum wage attached inside the stimulus bill. So once that got included back in the bill, the market took a dive. And I still think we see a stimulus bill, but I would almost bet my left nut that it doesn't get passed with this $15 per hour inside the stimulus bill. So rule number two, stay up to date with the news. It was very predictable that once the $15 per hour minimum wage hike was included back into the stimulus, that we were possibly going to see a sell-off. Also, same topic with the news. What happened in Texas? It was very evident that the renewable energy space was getting blamed for what happened in Texas. The wind turbines froze up and people went without power for days and days and days. That was obviously going to affect what happened in this space. Look what happened to some of our stocks. Some of our favorite stocks in the market, in EV, in solar, in fuel cells, took a nosedive. This is one you want to buy right here when you see this kind of price action. You want to buy pullbacks in front of support and look for the bounce back higher. You don't want to buy in this parabolic price action because parabolic price action also often comes with a followed steep drop. You want to buy on that drop and look for the retest of those highs. That is my favorite strategy. I've been using it for years. It's made me a profitable investor and a profitable trader, not just over the course of 1 year, but over the course of many. That's the name of the game. Not doing it once, but doing it forever. So buying pullbacks in front of support, sticking to your plan is the key. Now, I love clean energy stocks. Still do love them even more on this recent pullback. Yesterday, I alerted Sunworks, SUNW, to the private Discord chat at $11 per share. We were buying the dip. There's support down here at $9 per share. I thought this was a great opportunity. We are already up over 20% on this trade, and I think it's going to be a monster winner for the chat. Why? Because we bought the dip on a company that we like long term, and we're going to sell the rip. We're not selling the dip, we're selling the rip. I love clean energy stocks. Hyliion sold off even more. I like it even more down under 17. I will keep accumulating. CLSK, CleanSpark, both a Bitcoin crypto play and a renewable energy stock. It's pulled back a lot. How about Plug Power? Love Plug Power long term. There are a lot of great companies out there that are trading at discounted price points. For those who say technical analysis does not work, check this out. We got support here at $37. You buy the dip in front of that support. Boom. What happens? You sell the rip. It's already up. What? That doesn't look like that big of a move from 37 to 48. That's a $10 move on a $37 stock. That is 30% plus right there in that little window right there. That is a huge move. Rule number 3, baby. You got to have a plan. You got to have a thesis. Why are you buying a stock? Are you just buying it because it's going up 100% every week? Is that why you bought CCIV? Is that why you used margin to buy Lucid Motors CCIV when it was up 300% because you were missing out? That's how you lose money. Okay, so we do not want to just chase. That is so key in this game to be able to survive. We have to be here long term. You just don't want to be in the market a couple months and then blow up. This is a long term. The turtle wins the race. The rabbit gets shot by Elmer Fudd and he gets eaten. All right, so we got to have a plan. We got to have a plan. All right, so the plan or the thesis. It doesn't matter whether you're taking a trade, a short-term swing trade, or a long-term investment. With a short-term swing trade, it may be more geared toward the technical side of things, looking at the chart, finding an area to buy at. With a long-term investment, it may be more geared towards the fundamentals. You like this company's business plan, you think it's too cheap based on the fundamentals, and you're looking for it over the next couple of years to go higher. Doesn't matter, you have to have a plan. Step number one in the plan, the buy zone. Where do you want to buy this stock? You're just not going to buy anywhere, right? You have an idea of where you like to own the company at a certain price. Maybe you think the company is a good deal at $40 a share. So you set a buy zone from maybe $40 to $35. That's your buy zone right there. And you hold off. Even though you love the company, you wait. Sometimes you're going to miss out. Sucks, but sometimes you're going to miss out on stocks that just keep climbing, and they seem to go up forever, like Tesla. I missed it. But there's 1,000 other stocks that if I would have chased that were going up, I would have lost money on. I should have added to Tesla 10 times over the last 5 years. I only have a very small position because I'm waiting on pullbacks, and those pullbacks just never came, right? So buy zone, stick to the buy zone. Stop loss. Number 2, stop loss. If your long-term investing is a little bit different, if you're going to hold for 5 years or a decade, it really doesn't matter. You probably don't want to have a stop loss because you're just going to be cost averaging down on dips, and you really don't care if it drops because you want to own the company for many, many years anyways. But if you're swing trading and you're just looking for a short-term move higher, then you have to respect your stop loss. You have the buy zone, then you set the stop loss under an area of support, and then you have to respect it if you're going to be a swing trader. Long-term investing, again, you really don't need that stop loss. Number 3, profit target. You can't hold forever. Now, long-term investing, your profit target may be 100%, 150% higher. But you have to have an idea eventually of where you're going to say, okay, I think this company has given me most of what I can get from it. This is my profit target, and I'm going to cash in here and reallocate some of those funds into some stocks that I think are better deals right now. So that could be up here. You say all-time highs. That's where I'm going to take a little bit of profit off and move it to another company that I think is a little bit cheaper. So that's what the plan looks like. You got buy zone, you have stop loss, and you have profit targets. I think everybody should have a plan when they're entering a trade. Keeps you safe, keeps you accountable, and if you stick to it long term, you will be successful in this game. And one other tip is have this 2 to 1. So you want this to 2, your profit target equal 2 times of what your risk is. That will help you in this long-term run as well. One more thing, this is very important. Margin trading has reached an all-time high. If you don't know what margin trading is, basically your brokerage will loan you money. Let's say you have $100 in your account at Webull or Robinhood. They will then give you $100 of their money for a small interest rate to trade with, so you now have $200 in your account to invest in the stock market. Margin debt is right now at all-time highs with almost $800 billion of debt out there that these brokers are lending to their customers. That's why this most recent pullback, a very tiny pullback I will say, in the overall stock market has created such a panic because everybody is using margin. And I also use margin, but I know my risk parameters, okay? I know how much risk I can take on, and I respect my plan. That way I don't get crushed anytime there's a pullback. If you own CCIV, for example, let's say you had an account of $20,000. So you put $40,000, 20 of your money, 20 of Weeble's money into CCIV at $48 a share. Let's call it $50 a share just for making it easier for math purposes. So you have $40,000, let's say $50,000. That way you can buy 1,000 shares. 25 of your money, 25 of Weeble's money. The stock initially spikes, you're up big, you're up $12,000, $13,000 on your position, but then something unexpected happens and Lucid Motors comes out and says our valuation is going to be way higher than expected. The stock takes a nosedive and is trading at $32 a share right now. So you are down $18,000 on your position, okay, of just 1,000 shares. You only had 25K in your account to start with, because remember the other 25K was Weeble's. So you only have $7,000 in your account right now. Your broker's margin department or the risk department is hitting you up, asking you for more money, or they're going to liquidate your funds, and your $25,000 that you started with is now $7,000. That is the risk in margin trading. One way to prevent this from happening is to diversify, number one, and always keep cash as a position. What do I mean by that? Let's say your average position size in your portfolio is 10%. So you put 10% of your portfolio into 10 different stocks. Make one of those positions cash. So if you have $100,000 in your account, keep $10,000 in cash, and that will help to protect you. And also, anytime we get a pullback in the market, you have a little bit of capital on the sidelines ready to buy the dip and get some good deals on these discounted stocks that we're seeing right now. When I see stuff like this happening, these stocks like these clean energy stocks, these EV stocks taking a dump over the last week, I absolutely love it, because I know this is a buying opportunity. You shouldn't be scared. I hate seeing people hurt and scared when these stocks drop. It's normal. It's a good thing. It's healthy. Attack it and make some money. Don't buy the FOMO'd out, hyped up stocks. That's not where the money's at. Just needed to do this PSA. I'm sorry if I ranted. I hope you got something from it. If you did, hit that like button for me. If you're new to the channel, hit the subscribe button. I love every single one of you guys. Let's make some money out there. Let's not chase the FOMO. Let's buy the dip, sell the rip. Let's take it to the moon. Catch you guys in the next one. Until next time, peace.